Welcome back to the Deep Dive, the place where we take the densest legal documents, the most complex research, and, well, we try to boil it down into something you can not only understand but actually use. If you deal with international business, cross-border investments, or maybe you're just sending money to a relative abroad, today's Deep Dive is, I think, your masterclass.
It really is.
We are strapping ourselves in for a structured step-by-step look into the Foreign Exchange Management Act, 1999, or as everyone knows it, FEMA.
Yeah.
Foreign exchange law, it can often feel like you're navigating a dense regulatory labyrinth, but we're here to provide the map and the compass.
That's the exact mission for today. We aren't just going to be reciting definitions from a textbook. The idea is to provide a structured one-to-one tutorial on the entire framework of FEMA.
Yeah.
The goal is to really decode the logic, to understand the practical implications, and hopefully establish a crystal clear understanding of how this act governs, every single rupee or foreign currency that crosses India's border.
So by the end of this, you should feel equipped to identify the regulatory path for almost any cross-border financial transaction.
That's the plan.
Okay, let's unpack this by starting with the crucial historical context, because understanding the intent behind FEMA, it tells you everything about its management philosophy.
It really does.
You simply cannot grasp the current environment without tracing the history, specifically the shift from the old regime.
Precisely. FEMA didn't just materialize overnight. It was the result of a necessary and massive philosophical shift in India's economic policy, really following the liberalization reforms of the early 90s.
Right.
Control over foreign exchange, it actually originated way back during World War II under the Defense of India rules in 1939. And this restrictive approach was then solidified post-independence with the Foreign Exchange Regulation Act, or FERA, first enacted in 1947 and then updated again in 1973.
And FERA is often remembered as the bogeyman of Indian business, isn't it? I mean, it sounds like it actively discouraged any kind of international trade.
It was notoriously restrictive, almost protectionist in its approach. FERA's whole emphasis was on strict regulation, or maybe more accurately, control.
Okay.
And non-compliance was treated as a severe, non-compoundable criminal offense. So if you contravene FERA, you could actually face imprisonment.
Wow.
And the law operated under the presumption of guilt. So you, the individual, had to prove your innocence to the regulator.
That's incredible.
That system was designed for an era when foreign exchange reserves were, really low, and the national priority was absolute preservation and control.
So FERA was all about hoarding and criminalizing any outward flow of currency, which must have created a pretty hostile environment for global business.
Yeah.
When did that mentality start to change?
Well, as the Indian economy grew, as it liberalized and globalized, and critically, as India's foreign exchange reserves began increasing substantially, that strict defensive stance was just no longer tenable.
It wasn't working anymore.
It wasn't conducive to the economic expansion that was needed. So the philosophy had to shift from control to facilitation.
And that transition from a criminal regulation to a civil management, that seems to be the core takeaway here.
That is the perfect way to summarize the shift. FEMA, which became effective on June 1st, 2000, was specifically enacted with these dual objectives. First, to facilitate external trade and payments, and second, to promote the orderly development and maintenance of the foreign exchange market in India.
So it signals a move away from punishing outflows to, I guess, thoughtfully managing the flows.
Exactly. And the penalties under FEMA are primarily monetary, not criminal, which reflects this whole new approach.
So the preamble sets the stage. Facilitate trade, payments, and promote an orderly market. Now let's look at the broad scope. What exactly does FEMA regulate, and what are the key mechanics defined within its structure?
The salient features, they cover virtually every interaction that involves a rupee touching a foreign currency or a person's residential status changing relative to India. We can break the massive scope down into, say, 6 key regulatory buckets for clarity.
Okay, let's do it.
First, it regulates transactions involving foreign exchange between residents and non-residents. What we're going to be meticulously defining as persons resident in India, or PRIs, and persons resident outside India, PROIs.
PRIs and PROIs, got it.
Second, it governs all cross-border investments. So whether that's foreign direct investment FDI coming into India by non-residents, or overseas direct investment ODI going out by Indian residents.
So it's a two-way street regulation, ensuring both inward and outward capital flows are managed transparently.
Exactly. Third, it dictates the handling of current account transactions, or CATs. Now, the underlying principle here is flexibility. CATs are generally freely permissible, but the central government reserves the right to impose, reasonable restrictions on them.
Okay, so they're mostly free, but with some guardrails.
Right. Fourth, and this is where the strict control remains, we have capital account transactions, or CAPATs. These are regulated much more tightly. They remain under the joint control of the Reserve Bank of India, the RBI, and the central government, and they are only allowed if they are explicitly permitted.
Big difference there.
A very big difference. Fifth, the Act imposes obligations on Indian exporters regarding the timely realization of their export proceeds and their mandatory repatriation back to India. This ensures that foreign earnings are actually bolstering the national reserve.
Makes sense.
And sixth, and this is perhaps the most practical, important point for day-to-day life, all dealing in foreign exchange must happen exclusively through designated authorized persons, or APs.
So your bank, a money changer.
Precisely. Authorized dealers like commercial banks, licensed money changers, or offshore banking units. These APs are the mandatory gateway for all legitimate foreign exchange activity.
That brings us to enforcement. If the RBI maintains the overall regulatory and monetary control, who's the actual agency doing the police work, the investigation, and applying the penalties?
That investigative and adjudicatory power is intentionally separated. It's entrusted to the Directorate of Enforcement, or the ED, as mandated under Section 36 of the Act.
I see.
This separation is really crucial for governance. The RBI focuses on monetary policy, setting the rules, and managing the market. The ED, as a dedicated agency, focuses solely on investigating contraventions, gathering evidence, and prosecuting offenses under FEMA and other laws like the PMLA, the Prevention of Money Laundering Act.
I find the extent of its application absolutely critical here. Where exactly does FEMA's authority reach? Is it strictly contained within India's political borders?
This is where FEMA demonstrates its, I'd say, expansive modern reach. Section 1 states that FEMA applies to the whole of India. But, and this is crucial for individuals and entities based here, its jurisdiction extends geographically to cover all branches, offices, and agencies outside India that are owned or controlled by a person resident in India.
Wow. So an Indian manufacturing company, a PRI, opens a small procurement office in Vietnam. That Vietnamese office, even though it's physically abroad and dealing in VND and USD, it falls squarely under FEMA's jurisdiction just because it's controlled by the Indian parent.
That's the precise implication of the owned or controlled clause. The scope is designed to regulate the foreign exchange position of Indian entities that are operating globally.
Okay.
And furthermore, the Act explicitly covers any contraventions committed outside India by a person to whom the Act applies. This wide jurisdictional reach ensures that residents can't simply bypass Indian law by conducting transactions through an overseas subsidiary or branch.
Now, when you're navigating this legal structure, simply reading the Act itself is only the starting point, as we noted earlier. It's a multi-layered system. How should a business person or, a curious individual approach reading and interpreting the full FEMA regime?
You should think of it as a legislative pyramid. At the very top, you have the fundamental law, the Act itself.
The foundation.
Right. And immediately below that, you have the rules, which are notified by the Ministry of Finance, the central government. These rules define the broad boundaries of what's permitted and what's prohibited. For example, the foreign exchange management, current account transactions, rules, 2000, those are set by the government.
So the central government sets the high-level policy rules.
Exactly. Then you descend to the operational level, the regulations. These are notified by the Reserve Bank of India, and they detail the practical mechanisms, the procedures, and the specific conditions for transactions that are permitted under the rules. The RBI is the operational engine.
Okay, the how-to guide.
In a way, yes. And finally, at the base of the pyramid, you have the detailed day-to-day guidance, the notifications and circulars, which provide specific amendments, clarifications, and rate changes. And for ease of use, the RBI compiles all regulatory instructions on specific subjects, like foreign investment in India, into these really user-friendly master directions.
So you really need to look at all the layers.
To understand any specific transaction, say an overseas direct investment, you need to read the Act, the relevant rules from the government, and the applicable RBI regulations and master directions all together.
Before we delve into the transactions themselves, we have to master the specific vocabulary FEMA uses. I mean, getting these foundational definitions wrong can misclassify an entire financial activity.
Absolutely.
Let's start with the key actors, the person, and that critical gateway, the authorized person.
Okay. The definition of person is exceptionally broad under the Act. It naturally covers individuals, Hindu undivided families, or HUFs, which, for our non-Indian listeners, is a family unit recognized under Indian tax and law companies, firms, and associations of persons. But what is absolutely critical for the scope we just discussed is that the definition also includes any agency, office, or branch owned or controlled by such person.
That inclusion feels like a real heavy lifter in the Act. It gives legal personhood to something that might not be a separate legal entity in a traditional corporate sense.
It is. FEMA grants these agencies or branches, even if they lack independent corporate status, the legal status of a person under the Act. And this is vital because it allows the rules, particularly the residential status rules, to be applied effectively to operational units, not just the ultimate parent entity.
And serving as the absolute gateway for all regulated activity is the authorized person, or AP. Who are these designated gatekeepers?
The AP is the exclusive conduit. Section 2C defines them as an authorized dealer, which are primarily banks, a money changer, an offshore banking unit, or any other person specifically authorized by the RBI under the Act to deal in foreign exchange or foreign securities.
So a foundational principle.
It is. If you are transacting foreign exchange, you are obligated to route the money through an AP to ensure regulatory oversight and, of course, transparency.
Let's move to the assets themselves. We need to distinguish between, physical currency and the broader concept of foreign exchange.
Right. There are about 3 levels of classification here. At the simplest level, currency notes refers very narrowly to physical cash, so coins, banknotes, government notes.
To stuff in your wallet.
Exactly. The term currency, however, is much broader. It includes currency notes, sure, but also almost every common instrument used in modern finance. Postal notes, postal orders, money orders, checks, drafts, traveler's checks, letters of credit, bills of exchange, and critically, credit cards or any similar instrument.
So a plastic credit card is actually currency in the context of FEMA, which makes sense because it facilitates instantaneous foreign exchange transactions.
Precisely.
Now, what about the big one, the encompassing term, foreign exchange?
Foreign exchange is the umbrella term for the whole subject matter of the Act. It includes foreign currency, certainly, but it also covers complex financial instruments. It includes foreign currency deposits or balances payable abroad, drafts that are drawn in Indian currency but payable abroad, and conversely, drafts drawn abroad but payable in Indian currency.
That's a very comprehensive definition.
It is. It ensures that any instrument that acts as a claim on or is convertible across currency boundaries falls under FEMA's purview.
And for international investments, the term foreign security. What's the key nuance there?
A foreign security is defined as any security shares, stocks, bonds, debentures, and so on that is denominated or expressed in foreign currency. Now here's the key nuance that can trip people up. It remains a foreign security even if the returns, like interest or dividends, are ultimately paid out or realized in Indian currency.
Okay.
The original denomination is the deciding factor, not the currency of the final payout.
Finally, just to round this out, we need the simple regulatory counterpoint. Import.
Import is straightforwardly defined as bringing into India any goods or services. It is the necessary contrast to export, and it defines one side of the current account transactions we'll be discussing shortly.
This next section, I think more than any other, dictates the entire regulatory landscape for you, the listener. In foreign exchange law, your status as a resident determines whether a transaction is freely permitted, restricted, or entirely prohibited.
That's right.
What makes FEMA's concept of residence so unique compared to, say, income tax law?
The fundamental difference is that FEMA status is dynamic and it's transactional. It is determined from a particular date based on the time of the transaction, unlike income tax, which often looks backward across the whole financial year.
I see.
FEMA needs to know your status right now to determine immediate permissibility. If we had to wait for a retrospective annual calculation, international commerce would just grind to a halt.
Okay, let's define the default. A person resident in India, or PRI.
The definition starts with the first limb. Any person residing in India for more than 182 days during the preceding financial year. And it's important to note, the citizenship of the person is immaterial here. Physical presence and duration dictate the initial rule.
Simple enough. But then we hit the exceptions, which are based entirely on intent. This is the second limb, which governs people going out or staying outside India. When does a PRI stop being a PRI, even if they met that 182-day rule last year?
This is where intent immediately overrides duration. The law states that a person who has gone out of India for one of three specific economically defining purposes is not considered a PRII from the date of their departure.
Okay, so what are the three purposes?
First, taking up employment outside India. Second, carrying on a business or vocation outside India. And third, any other purpose that indicates an intention to stay outside for an uncertain period.
Okay, let's use the classic example, Mr. X. He lived in India for 360 days last year, so he's definitely a PRII. If he leaves India on November 1st to start a new business venture in Canada, what happens to his status?
He becomes a person resident outside India, PROI, immediately on November 2nd.
Wow.
His previous duration of stay is completely nullified by his present purpose. His intent to carry on a business outside India triggers that immediate change.
So getting a green card in the U.S. would do the same.
Exactly. Obtaining permanent residency falls under that third category, demonstrating an intention to stay for an uncertain period, making them a PROI immediately.
That seems incredibly fast. So if I, as a PRII, am just leaving for a short vacation of 2 months, my status doesn't change because my stay outside is for a certain period.
That's it, exactly. The purpose has to indicate a change in domicile or a long-term economic shift. A vacation or a short training course just doesn't qualify as uncertain period intent.
So the inverse of that is the third limb, which governs persons coming in to India.
This is Section 2, VB. A person who comes to or stays in India otherwise than for one of those three specific residency-defining purposes. So, employment, business, or uncertain stay intent is treated as a PROI even if their stay here is long.
Okay, let's analyze the complex case provided. A person comes to India on June 1st to visit sick parents. They end up staying for 10 months, which is way more than 182 days in the current financial year. But their intent is clear. They will return abroad in 6 months once their parents recover.
In that scenario, they remain a PROI throughout their entire stay.
Why?
Because the purpose of their stay was purely personal and temporary. It wasn't for employment, not for setting up a business, and not with an intent to stay for an uncertain period. The person knows they will return abroad once that familial duty is complete.
So FEMA is forcing us to look beyond simple timelines and focus on the economic intention.
Intent is paramount.
We also need to cover the status of non-individual entities. A corporate body incorporated in India is automatically a PRI, but the branches, the operational units, require some careful analysis.
Absolutely. Let's revisit the branch status example. Printtext Computer, a Singapore-based company, is a PROI. It establishes a unit, the robotic unit, in Mumbai.
Right.
That Mumbai unit, being an office or branch in India owned or controlled by a PRI, is treated as a person resident in India, PRI. And this classification simplifies regulatory life immensely. It allows the Mumbai unit to operate just like any other Indian entity.
And conversely, if that Mumbai headquarters unit, which is a PRI, controls a branch outside India, say a high-value trading branch in Dubai,
That Dubai branch is also considered a person resident in India, PRII.
even though it's not in India.
Right. Even though it is geographically outside India, it is owned or controlled by the PII in Mumbai. This is how FEMA extends its regulatory reach over the global operations of Indian headquarter businesses.
Finally, let's clarify the student status.
Yeah.
A student goes abroad for a defined course, say a 4-year degree. One might argue that that is a certain period of stay, which would suggest they remain a PRI.
That is the statutory interpretation dilemma. It's a bit of a gray area in the text. However, the RBI provided a crucial clarification on this via an AP Circular number 45 back in 2003.
And what did that say?
It's a practical carve-out. Recognizing the high likelihood that students studying abroad often start taking up part-time employment or seeking post-study work visas, the RBI generally treats students as non-residents, or PROIs, from the date of their departure for studies.
So it simplifies things for them.
It does. It simplifies the access to foreign exchange that they require for their maintenance and tuition.
We've established the players, PRI and PRY, but establishing status is only half the battle. How does the RBI ensure every single foreign exchange dealing is transparent and routed through the official mechanism? That leads us directly to the absolute restrictions in Section 3.
Yes, the Act's primary anti-evasion mechanism.
Right.
Section 3 is the core restriction. It applies universally to all persons, resident or non-resident. It lays down 4 absolute prohibitions, which really underline the necessity of dealing only through those authorized persons.
And these are only lifted if specifically permitted.
Only if otherwise specifically permitted by the RBI or the central government.
Okay, what are those 4 hardline prohibitions?
The first is straightforward. No person shall deal in or transfer any foreign exchange or foreign security to any person who is not an authorized person. AP. You can't buy or sell foreign currency in the gray market. Simple as that.
And the second.
The second prohibition relates to outward payments. No person shall make any payment to or for the credit of any person resident outside India, PROI, in any manner.
So if I, a PRII, owe my overseas business partner, a PROI, some money, I have to remit that money through my bank, the AP. I can't, for example, pay his domestic electricity bill here in India in rupees on his behalf.
Exactly. That domestic payment in rupees is considered a payment for the credit of the PROI because it reduces the PROI's domestic liability. That's prohibited unless it's specifically permitted. It's an unauthorized way of settling an international liability.
The third prohibition is arguably the most important for market stability, isn't it? It targets the core of illegal foreign exchange transfer, known as hawala.
This is the crucial anti-hawala provision. No person in India shall receive any payment by order or on behalf of a PROI otherwise than through an authorized person.
How does that work in practice?
Well, the mechanism of hawala often involves receiving a local currency payment in India without the corresponding foreign currency ever entering the official Indian banking channel.
Right.
The explanation under Section 3 makes it explicitly clear. If a PRII receives a local currency payment without a corresponding inward remittance from outside India, that is routed and converted by an AP, that is deemed to be a prohibited receipt outside the authorized channel.
I see the regulatory challenge there. If I, a PRI, receive 50,000 rupees in cash from a local agent who says, this is payment from your brother in Dubai, and there's no record of U.S. dollars coming through the banking system.
That cash payment is a contravention. It circumvents the mandated AP conversion.
And what's the risk there?
It prevents informal, non-banking transfers of value that skip the official foreign exchange mechanism. This can mask the movement of capital and potentially aid tax evasion or even money laundering.
And the final restriction.
The fourth prohibition addresses hidden capital outflows. It bars entering into any financial transaction in India that serves as consideration for or is associated with the acquisition or creation of any asset outside India by any person.
What's the goal of that?
It's designed to ensure residents aren't secretly acquiring foreign assets using unauthorized domestic financial mechanisms, like setting up a complex loan repayment structure in India that's actually financing an offshore property purchase.
So Section 3 governs unauthorized transactions and flow. Section 4, on the other hand, addresses the unauthorized holding of assets. What is the fundamental principle here for PRIs?
Section 4 basically prevents Indian residents from hoarding foreign assets. The rule is sweeping. Except, as provided in this act, no person resident in India shall acquire, hold, own, possess, or transfer any foreign exchange, foreign security, or any immovable property situated outside India.
That sounds incredibly restrictive for a globalized world. If a PRII inherits, say, US $10,000 from a relative in London, they can't just keep that money in a foreign bank account, can they?
That's the default rule. Unless a specific notification or exception, like the LRS will talk about, permits them to hold it, the Indian resident can't just retain those foreign funds or property outside India.
So what are they required to do?
They're required to ensure the timely realization and repatriation of the funds, which means they have to bring them back to India and convert them into rupees, thereby increasing India's foreign reserves.
We have the actors and the fundamental prohibitions. Now we have to dive into the two major categories of financial activity, current and capital. Let's start with current account transactions, or CATs, under Section 5. What's the philosophy here, and why are they treated differently?
The philosophy mirrors the conceptual difference between, say, the profit and loss account and the balance sheet in accounting. CIs are the transactions related to revenue items, trade, and services, the flow of day-to-day business income and expenditure. The fundamental principle, which is enshrined in Section 5, is freedom. Cs are freely permitted, subject only to the power of the central government to impose reasonable restrictions in the public interest.
Now, Section 2J defines a C negatively, as a transaction other than a capital account transaction. But it does explicitly include 4 core types.
Yes, the 4 types included are, first, payments due for foreign trade, services, and short-term banking and credit facilities. Second, payments due as interest and net income from investments.
Right.
Third, remittances for family living expenses abroad. And fourth, expenses for foreign travel, education, and medical care.
Let's clarify the boundaries using the trade examples. If an Indian resident imports some high-value machinery from the UK, in accounting terms, that's capital expenditure, something that will sit on the balance sheet for years.
Uh-huh.
How does FEMA treat it?
Under FEMA, this is classified as a current account transaction. The logic is that the payment for goods received, once it's completed, doesn't create or alter a long-term cross-border asset or liability of a financial nature. It's a settlement for a received good or service.
That's a crucial distinction between accounting principles and FEMA classification.
A very important one.
So what if that machinery is imported on short-term credit, say, a 90-day revolving line of credit? That certainly creates a temporary liability outside India.
Even then, because Section 2JI explicitly includes short-term banking and credit facilities in the ordinary course of business, it remains classified as a SAT. The intent is to facilitate standard international trade practices without subjecting them to the strict regulatory controls that are reserved for long-term capital flows.
Let's look at a personal transaction. A PROI transfers US $50,000 to their son abroad as a gift. It's a huge sum, but under FEMA.
Under FEMA, this transfer of funds, once completed, doesn't create or alter a long-term cross-border financial asset. It is a current account transaction.
And this highlights why the government needs that power to impose restrictions.
Exactly. If large gifts were entirely free, capital flight could be disguised through unlimited gifts.
So the central government uses its power under Section 5 to issue the Foreign Exchange Management Current Account Transactions Rules 2000, which defines what is prohibited, restricted, or fully permitted through 3 schedules.
Right.
Let's break down the policy logic of these schedules, starting with Schedule 1, Prohibited Transactions.
Schedule I covers transactions that are deemed speculative, undesirable, or simply counterproductive to national interests. These are absolute prohibitions. You cannot draw foreign exchange for these purposes under any circumstance.
And the policies to prevent what?
Could prevent an unnecessary drain on reserves for activities considered non-essential or even illicit.
What are some examples that reflect this anti-speculative policy?
This includes remittances out of lottery winnings, any income from racing, or payment for buying lottery tickets. It also covers commissions on exports made toward equity investment abroad. The regulators want the full proceeds of the export repatriated as currency, not reinvested abroad without specific approval. And crucially, it prohibits payments related to callback services of telephones, which historically were used to circumvent high international call rates and avoid official telecommunication charges and taxes.
Okay, next is Schedule 2. Transactions that require specialized, high-level approval from the concerned ministry or department of the central government. Why are these activities singled out for such specific oversight?
These transactions often involve public interest, national representation, or large sums being spent by public sector undertakings, or PSUs, which demands departmental oversight. For example, cultural tours require approval from the Ministry of Human Resources Development to ensure the tours align with national objectives.
Can you detail some of the financial thresholds that trigger this government oversight?
Certainly. Large advertisements in foreign print media placed by a PSU or a state government, if they exceed USI $10,000, require Ministry of Finance approval. Similarly, the remittance of freight costs for vessels chartered by a PSU requires Ministry of Surface Transport approval.
And the example of the prize money for sports.
Yes, the remittance of prize money or sponsorship of a sports activity abroad by a person other than a recognized international, national, or state-level sports body, if it exceeds US $100,000, requires approval from the Ministry of Human Resource Development.
So that ensures that only legitimate, high-level sporting organizations are freely remitting large amounts.
That's right. Private entities spending capital abroad for sports promotion must justify the amount to the government.
Finally, we reach Schedule 3, which governs the majority of personal cross-border remittances and is dominated by the hugely important Liberalized Remittance Scheme, or LRS.
The LRS is really the freedom mechanism for individuals. It allows all resident individuals, including minors, to freely remit up to USD $250,000 per financial year.
Okay.
This is a crucial combined ceiling that covers both permissible current account transactions from Schedule 3 and also certain permissible capital account transactions. It's designed to facilitate routine personal and minor investment needs without needing specific RBI clearance for every small payment.
What are the common purposes individuals use this $250,000 limit for?
The common uses include private visits abroad, giving gifts or making donations, expenses related to employment or emigration abroad, maintenance expenses for close relatives abroad, and of course, expenses for foreign travel, education, and medical care.
But the key is that the total of all these remittances has to stay within that USD 250,000 envelope.
It does, unless a specific exception applies.
So what if a genuine high-cost necessity, like a complex organ transplant or an Ivy League university tuition, pushes the requirement far beyond $250,000?
This is where the crucial override provision within the LRS comes in, which I think reflects a humane regulatory approach. For the specific needs of emigration, medical treatment abroad, or studies abroad, the individual may draw foreign exchange in excess of the $250,000 limit without needing prior RBI approval.
Yeah.
If the higher amount is explicitly certified as required by the foreign country, in the case of emigration, or the foreign medical institution or the university, this prevents regulatory caps from impeding life-critical or career-critical activities.
Let's shift to the restrictions on entities, so persons other than individuals under Schedule 3. What are the key monetary thresholds that force corporate entities to seek RBI approval?
Entities face strict scrutiny when remitting foreign exchange for specific non-trade purposes. We have three complex examples here. First, donations. An entity requires RBI approval if its donation exceeds the lower of two figures. 1% of the entity's foreign exchange earnings during the previous 3 financial years, or USD 5 mils in mil.
So that's designed to ensure large donations are proportional to the company's foreign earnings.
Exactly. It mitigates potential capital flight disguised as charity.
Second, commission payments on real estate sales, which often involve large chunks of foreign inward remittance.
Correct. Commission paid to agents abroad for the sale of property in India requires RBI approval if it exceeds USD 25,000 or 5% of the inward remittance, whichever amount is more. And that whichever is more part is essential.
Okay, let's run the calculation using the Akash Ceramics example. Akash Ceramics pays a 7% commission on a USD 600,000 sale. The commission is USD 42,000.
Right. So the 5% threshold on USD 600,000 is USD 30,000. The absolute threshold is USD 25,000. Since the actual commission of USD 42,000 is greater than both $25,000 and the 5% threshold of $30,000, RBI approval is mandatory for the entire remittance.
So the threshold structure ensures regulators can review it whether it's high percentage-wise or high in absolute value.
That's the idea.
And the third major limit is for consultancy services procured from outside India.
This one depends entirely on the nature of the project being consulted upon. If the consultancy relates to critical infrastructure projects, the threshold is higher. Exceeding USD 10,000 per project requires approval.
Okay.
However, for all other general consultancy services, say for software or publishing, the threshold drops significantly to exceeding USD 1 million dollar per project.
So if Mojita Periodicals obtains specialized software programming consultancy for $1.2 million, since that's not an infrastructure project, the transaction exceeds the $1 million cap and needs prior RBI approval.
Precisely. This tiered system shows how the government encourages foreign exchange spending on critical infrastructure while maintaining tighter control over general and potentially avoidable service remittances.
So that makes the default status of CSTs clear. If a transaction isn't mentioned in Schedule 1, prohibited, Schedule 2, government approval, or Schedule 3, LRSRBI approval,
then it can be freely undertaken. That is the ultimate test for current account flows. Freedom, unless specifically curtailed.
Now we shift to the other half of the regulatory world, capital account transactions, or CAPATs, under Section 6. If Cs deal with flows, CAPATs deal with stock. What is the defining characteristic of a CAPAT?
A CAPAT is defined as any transaction that fundamentally alters the stock of cross-border assets or liabilities. Specifically, it alters the assets or liabilities outside India of persons resident in India, or it alters assets or liabilities in India of persons resident outside India.
So we're talking about major balance sheet items.
Exactly. Investments, borrowing, transfer of immovable property, and the acquisition or creation of foreign assets.
And since the Indian rupee is not yet fully convertible on the capital account, these CAPATs are handled far more cautiously than CGATs. You mentioned they are permitted only to the extent prescribed.
That's the crucial difference in philosophy. Capital account transactions can be carried out only to the extent specified by the central government or RBI regulations. This is strict control.
And the mechanism for that control has changed.
It has. It underwent a key change post-2019, which formalized a dual control structure under Sections 6.2 and 6.2a. The Reserve Bank of India, RBI, in consultation with the central government, now regulates transactions involving debt instruments.
Like loans and external borrowing.
Right. And the central government, in consultation with the RBI, prescribes the rules for transactions involving non-debt instruments.
So that would be equity investments, acquiring shares, property.
Correct. This split allows for specialized regulation based on the nature of the financial instrument.
Before diving into what is allowed, what assurance does the Act give regarding the repayment of existing obligations?
Section 6 provides a foundational assurance on this. It states that neither the RBI nor the central government shall impose any restriction on the drawal of foreign exchange required for payment, due on account of amortization of loans, or for depreciation of direct investments in the ordinary course of business.
So your loan principal repayments and scheduled capital maintenance can't be restricted by future policy changes.
That is the assurance.
Since caps are restricted unless permitted, we need to look at what is, in fact, permitted. For our audience, this often centers on investment flows.
Absolutely. For PROIs, the major permissible cap adds are governed by the Overseas Investment, or OI, regime. This allows Indian entities to engage in oversized direct investment, ODI, which is acquiring a substantial stake in a foreign entity for strategic control.
Okay.
Or overseas portfolio investment, OPI, which is acquiring less than a 10% equity stake purely for financial returns. These are permitted under specific regulations and often require routing through the LRS limit for individuals if it's OPI.
And conversely, for PROIs, inward investment is highly encouraged, primarily through foreign direct investment, FDI, and foreign portfolio investment, FPI, routes into India.
Correct. Subject to sector-specific caps and conditions defined by the central government. The core of the cap-at regulatory framework really defines the conditions and limits for these two massive flows, Indian capital going out and foreign capital coming in.
Now let's address flexibility for individuals who change their status, specifically non-residents who return to India. They might have accumulated significant foreign assets while living abroad. This is covered by Section 6.4, right?
Yes. Section 6.4 is the crucial protection for returning residents. It permits a PRI to retain foreign assets that they acquired legally when they were a PROI. This includes their foreign bank accounts, any income earned from employment or investments while they were a PROI, or any gift or inheritance received during that period.
So if I return to India after working in Germany for 10 years, I don't have to liquidate my entire German retirement fund or sell the house I bought there.
Correct. You can retain those assets, and you can even continue to utilize those eligible funds and the income generated from them for payments or fresh investments abroad, provided the cost is met exclusively from those specific foreign-held resources.
And Section 6.5 protects the mirror image, the Indian assets of a person who moves abroad.
Exactly. A PROI can legally hold, own, transfer, or invest in Indian currency, Indian security, or immovable property situated in India if that asset was acquired or owned by them when they were a PRI, or if they inherited it from a PRI.
So it ensures their legacy assets in India, a house, shares in an Indian company, are protected from regulatory hassle simply because they changed residence.
Precisely.
Finally, let's list the transactions that are absolutely prohibited for non-residents. So PRIs investing in India. What is on that hard stop negative list?
The prohibition targets specialized, risky, or you could say non-developmental activities. Non-residents cannot invest in chit funds, though non-resident Indians can subscribe on a non-repatriation basis. MIDI companies, which are mutual benefit finance companies. Agricultural or plantation activities, and crucially, real estate business.
We must be crystal clear on the real estate business exclusion, as this often causes confusion with construction.
Yes, the distinction is vital. The definition of real estate business specifically excludes development activities. Like townships, construction of residential or commercial premises, roads, bridges, and investment in real estate investment trusts, or REITs. These development activities are actively encouraged through FDI. The prohibition is aimed at speculative land trading or just simple buying and selling of property for profit, not construction or development projects.
And we should acknowledge the specific political restrictions relating to sensitive jurisdictions.
Yes. The government maintains a negative list related to investments and financial transactions involving citizens or residents of Pakistan, Bangladesh, and the Democratic People's Republic of Korea or North Korea. These are subject to special review or absolute prohibition, reflecting India's commitment to international security frameworks.
For
example, entities or citizens of North Korea that hold existing investments must liquidate or dispose of them within 180 days unless explicit central government approval is granted for them to continue.
So the ultimate regulatory test for capital account transactions is, if it's not on the explicitly permitted list of the regulations, a specific prior approval is required.
That is the core difference. Current account,
Mhm.
permitted unless restricted. Capital account, restricted unless permitted.
We have dissected the entire architecture of FEMA, from its shift away from FARA to the nuanced control over current and capital flows. To distill this entire deep dive for the listener, what is the single most important mechanism you want them to internalize?
The core message is that FEMA manages foreign exchange flow by classifying two elements. The person, so PRI versus PRI, and the transaction, current versus capital. For you, the listener, understanding your status based on economic intent, not just duration, determines your entire regulatory burden. Current transactions are largely free, managed by the LRS limit for individuals. Capital transactions, because they affect the country's long-term financial structure, are strictly controlled by permitted lists issued by the RBI and the central government.
We saw repeatedly that FEMA's definition of resident is unique. It's a sophisticated regulatory tool that allows India to balance capital flow management with genuine economic integration. It looks at the substance of your stay, your employment, your business, not just how many days you spend here.
That distinction where purpose trumps duration is both the genius and the complexity of the act. But as global connectivity increases, phenomena like remote work and the instantaneous transfer capability of digital assets like cryptocurrency, they begin to challenge this foundational principle.
Which leads us to a crucial final thought for you to consider. FEMA's definition of residency is based on physical presence tied to economic purpose. But in a world where a person resident in India can earn income in US dollars and acquire digital assets located entirely outside India without ever physically leaving the country or routing the funds through an authorized person, how will regulators further evolve the definition of a resident? Can they effectively manage capital flow and ensure compliance when the location of the asset and the location of the financial activity become completely decoupled from the physical location of the person?
It is the ultimate regulatory tightrope, balancing the need for sovereign capital management with the relentless march of individual financial freedom in the digital age.
A fascinating test for the coming decade. Thank you for walking us through the complex but crucial world of the Foreign Exchange Management Act. Until our next deep dive.